Hi, this is Brett Senkis. I'm a business lawyer and an M&A broker, and we're talking today about different types of M&A buyers. Specifically, we're talking about financial buyers, or generally private equity firms. It's a special type of buyer. They have their own motivation, and they have their own sort of unique pros and cons from the standpoint of a seller. Private equity investors are firms that have a lot of money, usually raised a lot of outside capital to come in and buy companies and to grow them and turn them around. We call them financial buyers because they're just looking for a financial return. They may have experience in the industry. They may be buying a lot of companies in the industry, but they're not really viewed as like, they didn't start a company. They come in and they take over companies and they're looking for a return for their investors. So these buyers are, every buyer is different, every seller is different, that goes without saying, but there's certain common things that are common among these types of buyers vis-a-vis the others. So let's start with financial buyers. These are companies, organizations that have big piles of cash. Some of them like Carlyle Group, Blackstone, KKR, Kohlberg Kravis, and I think it's Roberts. These are huge private equity firms with, they'll raise $5 billion funds to go turn around companies. We operate in the $1 million to $25 million M&A market. They're not operating there. They're buying billion-dollar companies and $500 million companies, and they're just doing much, much, much bigger deals. In this part of the world, though, private equity is still very active. We see private equity groups buying million-dollar companies. It depends. Those are usually smaller funds. They're usually rolling companies up, meaning buying a whole bunch of companies to put them together and maybe, sell it or take it public. They're unique issues compared to individuals and strategic buyers, things that you can generally count on the positive side, if you're a seller, are that they don't get cold feet, right? This is what they do. They buy companies. So it's not that they won't walk away. They're fairly disciplined. They've looked at a lot of companies. Oftentimes they've looked at a lot of companies in your space, so their antenna might go up for things that are wrong. They know there's other opportunities out there, but generally they're not going to walk away just because they're nervous about closing a deal or something, just generally, right? Whereas an individual we'll get to may do that to you. Private equity they're in the business of closing deals. They want to close your deal, there's no question. Also, the process from signing a letter of intent or getting things going to closing the deal will be considerably smoother. It's probably, it's a term I want to use, but it might be better to say it's more structured, meaning it's going to be more, they might put you through the ringer. I'm going to get to that in a minute, but it's like it follows a clear course. There's not usually a lot of wavering. There's not usually a lot of, do we want to close this? Or it's usually just, you kind of know what you're going to get with a private equity firm. And what you're going to get, and I'll get into this in the cons, or things that are not great about it, is that you're going to get a very fulsome process. They're going to conduct a lot of due diligence. These deals are heavily lawyered, but you, again, kind of know what to expect, and it follows a course, and they're fairly rational, and it's just, it tends to be a less emotional experience. That doesn't mean that they don't get what we call deal heat and they want to close a deal. They do, but it's just a more consistent closing process. On the negative side, if you're dealing with a private equity firm, is that tends to be a more rigid, a more heavily lawyered transaction. They tend to do a lot of due diligence, and that my theory on this is that even if it's a $1 million deal, the private equity people come in like they're doing let's just say they do $20 million deals normally, and they're buying your $1 million business, they're still going to apply their same process and people to your $1 million business. That's just what they do. They appreciate the value of lawyers in the M&A space. They appreciate the value of good professional advisors, tax and accounting help, and they want them in there on those smaller deals. And they don't care if the amount of money they spend is a little out of whack with the size of the deal. They just don't. They run a standard process. They view it as a cost that they spread across all their deals. So if you're selling $1 million business, you're dealing with private equity, you can expect they're going to ask a lot more questions. It's going to take a lot longer to close. I should have touched on the pros, the good things about private equities. They usually have their money already lined up. Now, sometimes they use a lot of leverage, some private equity shops, which means they go get loans. But in the part of the market where we operate, $1 million to $25 million, usually private equity is just going to pay cash. And that's better than when we get to individuals who have to get financing. That's a much, much bigger risk. So add that into the pros, at least in the lower end, the Main Street and lower middle market again, 1 million to 25 is kind of our space, you're going to see private equity usually just paying cash, so that's good. On the negative side, we touched on it's a more fulsome process. You might feel like it's a root canal. There's lots of questions. They will look at a lot of stuff to be heavily lawyered, things like that. Also on the negative side with private equity is they generally will want you as the seller and your team to stick around. Okay, now that might be good. You might want the job, but oftentimes you want to move on to greener pastures. You don't really want to have to stick around. And they'll often want you to because they need the management team there. They may have some redundancies if they're rolling up companies, they're buying a lot of companies in an industry. There may be some overlap, but generally speaking, compared to strategic buyers, private equity is going to want the people to stay around more, and that can be lucrative. There can be stay bonuses, and they're much quicker to give out equity incentive plans, in my experience, than strategic. So that's good. But if you want to just say, here it is, here are the keys, good luck, that's going to be less likely you can do that and still get your deal closed with a private equity buyer. The last thing I'll touch on negatives with a private equity buyer is that, generally speaking, you can expect that their offer to you, the purchase price, is going to be less. That's because they don't have synergies they're bringing to the table usually. They might just be looking to turn this business around, so they're going to be a little bit tighter on price. Now, that's not always the case. I run into a lot of private equity firms that are buying companies up and rolling them up in an industry, and they do look at it like there's synergy, and they really are trying to put these companies together. They're looking to pay 3 or 4 times EBITDA and then put this all together and take it public or sell it for 8 times or 10 times or something. So they're sort of viewing it as the whole is greater than the sum of its parts kind of thing, and they're willing to pay and be aggressive. They want to close deals, and they don't want to be outbid. So that really depends on what kind of private equity buyer you have. Again, if they're rolling things up, that's probably one that just wants to pay and wants to do deals, and they don't want to lose a deal over price. But if they're not in this industry normally, they're being opportunistic and just finding a good way to make some money, they're going to be a little bit tighter probably on what they pay. So thanks for joining me today, talking about private equity buyers. Check out my next video where we're going to talk about competitors or strategic buyers, which is another type of buyer. They're different than financial buyers. They've got different motivations. They've got different pros and cons. So as a seller, you want to understand them as well. Thanks for stopping by today.